Hello, my name is Desiree Elias. I am the Assistant Controller at FIU. Today we're wrapping up the accounting review portion of the Budgeting 101 presentation. And we're going to do this by putting the lessons that we learned in the last two sections together through an example, an illustration. Before we do that though, let's get back to reviewing just a couple of basics. Remember the results of accounting. We track two things. Again, the operating performance of an activity and the resulting effect on fund balance. Now, this operating performance, the language that we use or the word that we use to capture this is income. Income represents the net operating performance during a period, for a period of time, whether it be a month or a year. When we say net, it is because income are revenues less expenses. That is net income. Now on the financial position side, financial position is measured at the end of a period or on a specific date, whether it be the last date of the month or the last date of the year, for example. The word or the phrase that we're going to use here is fund balance. Fund balance represents, again, the net financial position. It represents what resources, total resources, you have left to spend or available to spend at any given time. Now the formula here is cash plus receivables less payables equals fund balance. Now this is very basic in accounting. Accounting again has two sides and they always have to balance. So you have in this case a formula with two sides. You have cash and receivables, which are your assets, less payables, which are your liabilities. Assets less liabilities equals fund balance. That equal is very important because it always has to balance out. Now, for those of you that might be familiar with financial accounting, fund balance equates to what in financial accounting we call our net assets or our equity balance. It's the residual balance, your assets less your liabilities. Now, how does the fund balance change? Let's say we start with the beginning fund balance during the period. We're going to add in our income, our net income, which is, once again, revenues less expenses. We're also going to add in any cash that came in as a transfer from another department. We're going to subtract any cash that went out to another department, and that will give us our ending fund balance. Now let's review an example that hopefully will bring all this together for you. One of our colleges creates a new academic program, and classes are going to begin on July 13th. But obviously, before classes begin, we have to do certain things. We have to register students. We are going to hire a program manager to start administrating the program details, and we need to purchase some items. First thing we need to do, though, before anything else, is figure out how we're going to start this program. Meaning, how are we going to fund the program manager's salary before we actually collect on any of the revenues? There's a timing lag here between when our expenses start and we start to actually see the cash coming in from our revenues. That being the case, we're going to ask another department, another unrestricted department, to loan us $10,000 as startup funding temporarily so we can get this new activity started. So what happens? We receive a $10,000 in cash from another department. Our cash goes up by $10,000. And again, since in accounting there's always two sides to every transaction, the other side here is the cash transfer in. Cash transfers in affect your fund balance. Cash goes up, fund balance goes up for what represents a cash transfer in. Just a quick reminder, let's go back to the previous slide. Remember what are the movements within the fund balance. Income plus cash in plus cash out. So now it's time to go ahead and register students. Well, actually, first we have to hire the program manager. The program manager was hired on June 1st, So we're going to pay the program manager for the 2 pay periods that occurred in June. We're going to pay the program manager $5,040. Actually, we're going to pay them a little less, but there's a benefits portion. So that includes the benefits. That's the total expense. Our cash goes down by $5,040, and our fund balance also goes down by $5,040, representing expense. In this case, it would be salaries expense. We also had to purchase a laptop for this new program manager, $1,200. Cash goes down by $1,200. Again, an expense is incurred for $1,200. In that case, it would be an operating expense. At some point, we also have to register students for these classes. Or students register themselves, I should say, for these classes. So, we're going to record a receivable, or the student's financial system is actually going to record a receivable for $52,000. Our assets go up by $52,000 for that receivable. Our fund balance also goes up for the $52,000, representing revenue. Note here, we actually haven't collected the cash yet for these classes, but we do record the revenue. Fund accounting rules, you record the revenue earlier of, or when it's measurable and available. It is measurable and available at this time. This is one of those accrual accounting concepts, meaning that the revenue recognition is different than the actual cash. You want to record revenue based on the revenue recognition criteria, not necessarily when the cash comes in. So, at the end of June, our cash balance is $3,760. We have an outstanding receivable for $52,000. And the sum of those two equals $55,760, which is the fund balance at the end of June. Okay, let's keep going. We are now in July. Students pay for their classes. At that point, my receivable has been reduced and my cash has been increased. Note that this has no effect on the fund balance. All you're doing is reclassifying one asset account to another asset account. The program manager is paid for the first pay period in July through July 12th. With benefits, that total is $2,520. Your cash goes down. Again, your fund balance goes down for salary expense. We're going to go ahead and buy food for the students for the month of July. This is one of those value-added programs where food is included. However, the vendor doesn't require us to pay for the food until August 5th. So they give us about a week to pay. So in this case, we're going to still record the expense because we actually incurred the expense. We bought the goods during the month of July, even though we don't have to actually pay in cash until August. So we're going to record a payable for $4,000 to this vendor, and that's going to increase our payables. We're going to reduce our fund balance by the $4,000, representing expense. In this case, it would be an operating expense. Now, classes start on July 13th. We start paying the faculty member for teaching the classes. So, for the second pay period in the month of July, which ends on the 27th, we have payment for the faculty and the program manager. With benefits, it's $6,400. Again, our cash goes down by $6,400, and our salary expense is recorded, reducing fund balance. At this point, near the end of July, we have already made enough money here that we can pay back that original startup funding. We're going to process a cash transfer out. It's going to reduce our cash. It's going to reduce also our fund balance. And the money is going to be sent back to the other department. So at the end of July, our cash balance is $36,840. We do not have a receivables balance. We collected all the pending receivables. We still have $4,000 due to our food vendor, so we have a payable for $4,000. The sum of those two, or the net of those two, is the fund balance of $32,840. Now the reason that these two numbers, the $36,840 and the $32,840, are in red is because I want to highlight a very important concept here. Cash balance does not equal fund balance. Now at FIU, sometimes what happens is that we equate fund balance with cash. So when we're looking to see how much cash we have available at any given time, we just pick up the fund balance number. That is not the case. That is not necessarily the case. There's other things that affect fund balance, things that are generated through receivables and payables. So it may not always be the same number. If you are working at an academic unit and you have a very high accounts receivable number, then your cash balance is going to be lower than your fund balance. If you need to determine how much money you have available to make future purchases, you want to look at your cash balance. Now, this is not applicable to everyone. There are some units where there should be very little difference between the two amounts, in which case you may be okay using the fund balance. But if you're one of those units that have a large receivable balances or payable balances that are going to be different, or that are going to cause reconciling items between your cash and your fund balance, just be aware of that and take it into consideration. One more slide. The final slide here, the result of this. Okay, what this does is this references our roll forward of our fund balances. Remember, we have beginning fund balance. Our fund balances go up for net income or loss. The fund balance also goes up for any cash transfers in and down for any transfers out. That will create our ending fund balance. So in the month of June, our beginning fund balance was $0. We had revenues of $52,000. We collected those revenues in July, but no matter, we still recorded the revenues in June. We had salaries and benefits of $5,040, operating expenses of $1,200 for the laptop. That gave us net income of $45,760 for the month of June. But remember, we got the original $10,000 startup funding. We're going to show that here, represent that here, below our net income line as a transfer in, cash transfer in. So our ending fund balance at the end of June is $55,760. This becomes our beginning fund balance in July. What happened in July? We didn't have any revenues. We collected the revenues that were recorded in June in cash, but we had already recorded those revenues. Again, accrual accounting, timing differences. We had salary and benefits, $8,920. Operating expenses of $4,000 representing the food. Again, we didn't pay for the food in July. We paid for the food in August. But since we incurred the expenditure in July, we recorded the expense in July. Our net income, or loss actually, in July was a loss of $12,920. The reason you have a loss here is because your revenue was recorded in June. It's just a timing thing. Now, we also paid back the startup loan. So we have a transfer out for $10,000. So our ending fund balance at the end of July is $32,840. That concludes the accounting review section of the Budgeting 101 presentation. I hope that the preceding example was helpful to you. And there are many opportunities to get additional training on accounting and finance matters. Please refer to the Controller's Office website. The Financial Systems Group has several trainings that you can attend that will give you more examples and more access to reports. Thank you for your time and have a nice day.